as we say goodbye to 2015, it's time to take stock of what to do with your money in 2016. And what a year it has been, right? The Nifty has been down 6.25%. Mid-caps have been up, but I won't really go by the headline number for the index, considering it's been all about individual stocks. Government bonds, they've slid about 2.5%. Gold has been disastrous, almost a 7% fall. And yes, fixed income, which is as good as sitting on cash, has delivered about 7 to 8% returns. And this at a time that 50% of the macros, that's the crude fall, and the RBI cutting down rates has worked in favor of the Indian economy. By the way, the Reserve Bank has managed to cut base rates by a good 125 basis points, and that's a stupendous rate of cut really coming in the calendar year 2015. So let's take stock of what to do then with your money in the year ahead. Nilesh Shah, MD at Kotak AMC, Chandresh Nigam, MD and CEO at Axis AMC, and Dhirendra Kumar, CEO at Value Research, join us right now on the show. Gentlemen, good afternoon. And Nilesh, let me start off with you. How different is 2016 going to be? Like I reiterated, crude oil prices as well as base rate cuts have been in our favor, yet we've underperformed. It's only fixed income which has given us the best return so far.
Mid-cap funds have delivered better return than fixed income funds.
But that's been about individual stocks, you know. I mean, as an asset class per se, you haven't.
It's all about stock and stock.
Yes, it is.
You want to make money, you have to work hard. 2016 will be volatile like 2015. At the beginning of 2015, no one predicted crude will crash like this or interest rates will come down, but it won't be reflected into market yields. 2016 also will teach us some lesson. But at the end of the day, if we are disciplined in terms of picking up our stocks, in terms of having right investment horizon, 2016 will be as rewarding as 2015. In 2015, where people have made money, they have made money in credit accrual funds compared to duration funds. The same trend will continue in 2016. They have made money in mid-cap funds, probably in 2016 as mid-cap valuations have become little over large cap.
Yes.
A multi-cap fund will be better. Stock-specific approach will still work in 2016. So my guess is that it's not what the asset class is going to do. It's what you do within that asset class in terms of picking up your stocks, in terms of picking up your securities. That's going to give you the return.
And that's what you gentlemen do best. I will come to that in just a bit. But Dhirendra, I want to get you in on the discussion. Now, fixed income, you know, the myth that we were talking about earlier on, before the show, interest rates actually coming down would hurt fixed income. Yet they have managed to deliver rates of about 7 to 8%. Is that kind of return here to stay? Will 2016 also give us 7 to 8% return? Or do you think there is a possibility of a breakout when it comes to fixed income returns?
No, I think Nilesh will be a better person to talk about. He has been a very big fixed income manager. But 2015 has been an anticlimax for investors. Investors got very, curious, motivated to invest in the markets. They got back anticipating a rate cut, which did not happen or did not translate into meaningful return for the fixed income. We haven't had a great year for fixed income despite the rate cut. We haven't had a great year ever since investors started coming on board. So it has been an anticlimax, and I hope that 2006 and markets, there is a general reversion to mean, and 2015 has been so relatively lackluster. I would not say greatly disappointing, but definitely nothing in line with what was the built-up expectation after 2014. Which came with much of a surprise, while most investors just watching the market going up relentlessly. So in that sense, I would say that one should be more hopeful. At the same time, I think the big thing that has come about in, which one should expect, that should translate into something very meaningful for investors, is that for the first time in a lackluster market, domestic investors have kept on putting money into equity gradually. I don't know what is driving it, whether it is the migration from gold or disenchantment with gold, or disappointment with real estate, and now the savings are finally getting channelized here, or it is the SEBI's incentives. I don't know which is contributing how much, but definitely we see that the kind of flows from domestic investors is virtually able to match the FII outflow during the year, which has led to a very different kind of stability in the market otherwise.
Dhirendra, hang on to that thought. I'm going to come to that curious case of DIIs actually putting in more money than FIIs in just a bit. But Chandresh, I want to get you in on this discussion. 7 to 8% at a time when the best of the rate cut cycle, I would assume, is already behind us is nothing great. Do you think there is a case that 2016 fixed income could actually outperform, or would it be status quo?
I think if you were to look at the entire fixed income markets, and just looking at it in isolation for 2015 may not be exactly right. I think this cycle started with the 10-year being more closer to 8.25, 8.5, and hence, to the extent, yes, we should have seen more, but we have got, say, about a 70 or 80 basis points drop in the 10-year, which kind of should correspond to more like 11, 12% total returns. What has been visible during the year is essentially, as you said, the 7 and 8%. And in that sense, I think the market has been disappointed. And also surprised. I mean, one would have thought that after the 100, 125 basis points cut, which we had, rate should have been much lower.
Yeah.
The fact is that it has not happened for various reasons. I think whether it is generally some global flows not happening, fixed income markets, FIIs not being investing to that extent, whether domestic requirements from the banks, the SLR is anyway excess in the system. So whatever those reasons are, the fact is that now the 10-year is like 100 basis points above the overnight. And that gives some room for optimism for 2016. So while we will, I think, see some more cuts happening in 2016, so that should drive yields lower, but also the spreads which we are seeing right now, which is about 100 basis points, should compress by 30 or 40 basis points at least. Looking at that, I think, and assuming that we do see 60, 70 basis points drop in yields in 2016, that's our assessment, I think you will be seeing, my guess is higher than 7 or 8% return in fixed income in 2016.
So a balanced approach would be it.
Right.
I want to come to the next asset class, and that's been, you know, the cluster of commodities, crude, gold, and aside of that, real estate. It's all come crumbling down. Is there more pain before a revival? Is a revival at all in sight? And I want to take your views on gold, considering that's a market you track closely.
So I think if you were to answer those questions, one will have to look at a little, I would say, the overall global picture, because many of these are global commodities. Real estate is anyway very, very situational and very regional in context. But looking at what's happening globally, I think we are talking about a secular trend now emerging, or number of trends emerging, which point to destruction in global aggregate demand. Now, that's not something very comfortable. It's not something which we have seen over the last 15, 20, or 25 years. We've always seen global demand actually accelerating and, in fact, growing at least at a stable pace. We are seeing things like change in demographics, populations aging. We're seeing things like deleveraging still happening in large parts of the world. We're also seeing disruption. I think one of the big things which is happening because of technology is the way erstwhile old businesses, and that means people with old skills, getting disrupted away out of, and there's lots of people moving out of economies, out of the economic life, so as to say. All this is giving a push on deflation, and that is what is now visible in the commodities space. Now, the question is whether this is just cyclical or this is more long-term in nature and hence more secular. And the world, as research is happening across, and the number of things like technology, etc., the labs, etc., which are coming out, there is increasing thought that this actually might be secular. If that is the case, then I think these are not places you would want to be from a strategic perspective. We all know it's very difficult to call oil prices, or for that matter, any commodity in the short term.
Yeah, no one thought it's going to slip below 40.
Like that, yes. But strategically, then it means that probably you don't want to be around that. Tactically, what will happen in a year in commodities is extremely, extremely difficult. There will be times when, because of technical reasons, options expiry, stuff like that, these commodities might rally. But I don't think these are really building up.
But they would be in a downtrend, you're saying. What is your view, Nilesh? Is there any revival in sight, or could they, see further pain?
So one, it's very difficult to predict commodity market. Why bother about it?
Okay, complete avoid.
There are various opportunities outside of them where you can make money. So focus what you can manage rather than trying to be in every space where you need to be. So, let's focus on simple things. Do a long-term investment, do a regular investment, do proper asset allocation, pick up few credit accrual funds, pick a few large and multi-cap funds. I think that's more than sufficient for you to make money in 2016.
No physical gold. And no ETFs.
On gold, my point is that, today the government has given us gold bond scheme. It's a great opportunity for us to pay for the sins committed by our fathers and forefathers. As a nation, we have spent in just last 10 years $221 billion in import of gold. It's more than $190 billion of FII flows which we have received in our debt and equity market. It's more than $170 billion of net FDI flows which we have received as a country. A poor country like India, instead of building schools, colleges, hospitals, is sending $31 billion abroad over FII flows. That's gross mismanagement of our financial savings. Hence, you have now gold bond scheme. Please put money over there. It will give you exact appreciation of gold. On top of it, you will be saved of the storage cost and those costs. You will also be saved of transaction cost because you buy gold in 2 gram, 5 gram, you pay 30-40% premium. And more importantly, you will receive 2.75% interest. So you are getting money. It's good for your country. Grab it with both the hands if you have to invest in gold. Compared to physical gold, gold bond scheme is far, far, far better.
And real estate, avoid?
Real estate is far more location specific. On a broad basis, it looks like as if real estate has reached a plateau where affordable housing and the lower end of the segment should do better compared to a luxurious segment. But at the end of the day, real estate in Hyderabad or Ahmedabad could be completely different from real estate in Mumbai.
Absolutely. Okay, so on that note, we're going to take a very quick break. We've talked about the best and the worst performing asset classes. When we come back after this break, we'll talk about our favorite asset class, equities. We've talked about fixed income, we've talked about the commodity space as well as real estate, which clearly has been in a void so far. But let's talk about equities. Where do equities lie at a time when we haven't really seen the best of performance from most equity funds, so to speak? One-off mid-cap funds have definitely looked better, but it hasn't been the best of year for equities. We're pretty much where we started off the year at the same Nifty level. So let's try and analyze the jigsaw puzzle, equities, and how should you be putting your money into this equity class going forward. And Dhirendra, I want to get you here first. The most mesmerizing fact, if I can call it, has been the fact that the number of SIPs have been equal to the number of demat accounts. Why is that happening? Is it the fact that none of the other asset quality classes, that's commodities and real estate, are performing well? Is it SEBI incentives, or do you think investors are now more seasoned and they've seen what has happened in the past, therefore they don't want to miss the boat this time?
No, I think all the reasons that you listed, they are all contributing. I don't think it is easy to find one reason for such a big move that has happened. Yes, it is SEBI's incentive for the smaller cities. To a great extent, it's a missed opportunity because what has happened in last couple of years that investors have always been Indian investors have always been a seasonal investors. So they have great regret of not being a regular methodical investor. I think our government has also contributed to it by our long-term saving finds its way into EPF or PPF or the GPF. So I think investors are first time being demonstrated that what they have missed out on, and there is a great regret or a feeling of missed opportunity. So I think it's a very nominal thing. If you look at the scale of SIP or the scale of flows, it looks like sizable, but it is insignificant going by the scale, the magnitude of our domestic savings in relation to that. But that is big news. That in itself has been able to take care of the kind of deceleration we have seen or outflows we have seen from FIIs. So that's big news, and I think it is just in the early phase of gaining momentum, and investors will benefit out of it because the seasonal investors who came in the last 20 years on all those key occasions which was inopportune, and they never turned out to be long-term investors, and they went back from the market forever. From that standpoint, I think this is the single biggest good news for our equity market and for our domestic economy as well as for our investors.
Has been, and hopefully 2016 will only be better. But Nilesh, like the chat that we were having before the show, it hasn't been the best performing, and we know it in hearts of heart. It hasn't been what the year ahead, before that was like. What would it take? Where would you see earnings revival coming in? Because the macros are in place. What would it take more for equities to really perform, and more importantly, reward people who've sort of entrusted their faith in equities?
So one, what Dhirendra alluded in the first part, in last 18 months, we have received more flows into equity mutual funds than the previous 10 years. And certainly they have not got the returns as per their expectation. Some are outright negative, some are muted, some are little positive. We need to work on engaging this 18 months flows so that they remain invested for next 18 months. If they go away now, by booking
they're not
their
coming
exit,
back. Yeah.
next 10 years I will be running after them.
Yeah.
So we must first engage with this 18 months flows, reassure them that look, the long-term story is moving on. The way to do it obviously will be financial education. They also must understand that this is the first year in our history that the nominal GDP is below real GDP. Earlier we had 6% real GDP growth and 12% earnings growth because 6% was inflation. Now we have 6% real GDP growth and 5.5% earnings growth because nominal GDP is running ahead of real GDP, running below real GDP. So we need to readjust that entry point. Correctly, you mentioned that it's the corporate earnings which is going to deliver return. There will be few components where corporate earnings will come back. One, interest rate needs to be reduced. Whole of calendar year 2015, we have seen negative wholesale price inflation. The manufacturers, the entrepreneurs are playing wholesale price inflation game. So for them, having a high real interest cost is really a burdensome thing. Second, we have seen an economy where rural India is in distress because of too below average monsoon. The private sector investment is on the back foot because of various issues, right from debt to ease of doing business. It's the government which is on the front foot and spending money. In such kind of scenario, capacity utilization for India Inc. has come down, and lower capacity means lower margin.
But again, government spending has happened in very long gestation sectors. Roads, yeah, shorter term, but railways, defense. I put in my money, I don't know after 10 years which company is going to benefit. You know what I'm saying?
It's not that the government's, all the monies are going into long gestation. Probably what is happening is that some of the short gestation monies are being spent more in the unlisted segment rather than in the listed segment. We'll have to play the derivatives of it. So if government is building dedicated freight corridor at a breakneck speed, maybe cement is a better bet. If government is spending money on road construction, then again suppliers of equipments to road construction industry in a small cap segment might be a better bet. So we'll have to play the derivatives of government spending, and the 7th Pay Commission could be a game changer from an investment point of view, where there will be more than 100,000 crore in the hands of 1 crore employees, which will be paid to them over 2016 and 2017. Now that money will be spent in white goods, automobiles, affordable housing, EMIs, and so on and so forth. So we'll have to play this derivatives in a manner whereby you can build a portfolio of small, mid and large cap companies which are benefiting from this. The other risk which is worth taking is that we never had 3 consecutive below average monsoon. Hopefully God will be kind next year compared to the past 2 years, and which is why the companies which are operating in the rural segment, where probably they have hit the bottom in terms of price as well as valuation, they could provide a high risk, high return opportunity.
So have exposure to both, you're saying. It's not like rural consumption is not going to kick
Absolutely.
back this time. What is your sense, Chandresh? Index funds or again, mid-cap, sector-specific funds?
So I think taking off from what I just mentioned to you earlier, I think the global scenario is not inspiring any confidence. And actually that's great news for us in India. But while we keep on saying that yes, the markets haven't performed, we still have that whatever 5-6% GDP, which is really something which most global investors will take it with both hands. But overall, the scenario is that looking at the fact that our investment cycle hasn't really kicked in, and hence the trickle-down effects which would have been expected from much higher GDP growth in the economy is not happening, not going to the downstream consumption sector, etc. I think the recovery is going to be slow, while still great in a global sense, which will get the foreign investors reasonably excited or keep them reasonably excited. But the growth is not going to be across all segments. We are not likely to see a tidal wave which is going to lift all boats and say all our 1,000 or 1,100
and
listed
no hope
stocks
rally either to play it, right?
going to do it.
Yeah.
So, but I think this 6% kind of growth rate is enough for some of the high quality businesses, companies with pricing power. That's the one thing which has really gone down with the slowdown in growth. People lose pricing power, and hence it's a double whammy. So you need to be with businesses which are able to kind of have some amount of pricing power, and 6% growth can then trigger a reasonable 8-10% growth for these businesses. So I think 2016 and then also for beyond, I would think a significant portion of allocations should be in high quality companies. So certainly not professing or any recommending index funds. I think this is going to be a very selective market. As actually, if you look at it from a long-term perspective, it's always been. I mean, if you look at it a 10-year period, only about 25 or 30% of the businesses really do well. The rest 60 or 70% of the businesses actually don't do that well. Short-term, now sometimes this difference is not really seen, but eventually it is the high-quality businesses which will do well. So I think investors should look at high-quality businesses directly or through funds and stick with them for the long run. This is not an investment just for 2016. I think the landscape beyond 2016 also, and the past obviously what has taught us is stay in good quality, high quality businesses, companies which have established themselves well, have in this age of disruption, will have their business models relatively less affected. I think those are the places you want to be for the long run.
Nilesh, would equities manage to beat the fixed income return for 2015 in the year ahead?
Definitely. If you say 2-year horizon, large cap equity funds have delivered about 20% return. It's far more than fixed income.
Yeah.
The mid caps have delivered 40% return. It's 39%, but I'm rounding off to 40. That's far more than the fixed income. It's just that 2015 in isolation, the mid cap funds were
Sticks
little
out
ahead
like a sore
of
thumb,
fixed income, and large caps were little below. But on a post-tax basis, equities delivered as good return as fixed income. Now, because we had moderation of return in 2015, there is a greater opportunity of making money in 2016 and 2017. Obviously, we need to work, God to be a little bit kind. But if you keep the faith in India's story, I have no doubt that 2016 should be better off than 2015.
And keep the faith in equities alive. Dhirendra, I want to come to you since you don't have any disclosure problems, and I want individual names here. 3 top funds for tax savers for 2016.
No, there are quite a few good ones, but if I have to choose 3, I would say Axis Long-Term Equity or the Birla Sun Life tax plan, or the one very aggressive one and a fairly impressive and could worth considering could be Reliance tax saver.
Right. And for beginners who may be just wanting to get into equities in 2016?
Yes, there are a large number of investors who still haven't got the equity story and they would like to have a steady take on growth. They should get started with balanced funds. And if I have to choose a couple of them, the relatively conservative one, I would say Tata Balanced or ICICI Prudential Balanced Advantage or Birla Sun Life 95.
What about people looking to park long-term money, say 5 years?
Here there is a problem of plenty, and it's really hard to choose 3. But I'll, don't look at it as my, order of chronology. And so many a times it could be just because I like the relatively older ones and I have a relatively easy recall. I would say Franklin Prima Plus or ICICI Pru Value Discovery. One new up and coming, fairly impressive, Mirai Asset India Opportunity Fund.
Okay, Dhirendra, always good getting names from you. I know the gentleman on my left will not disclose any stock names. So let's wind it up then on this hopeful note that 2016 definitely is going to be a brighter year for equities and all asset classes, hopefully. But gentlemen, good chatting with you today. Thank you so much for taking the time out and speaking with us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.